Welcome to our couple attendees, and then also for those of you listening to the rebroadcast of this later, thank you for taking the time. This is Quinn Arnold. Our session today is about the rather large piece of legislation that just came in at the end of 2020, somewhat related to stimulus and then a bunch of other tax code changes, some of which are pretty important for our clients. So with me today, as always, is Matt Hilland, one of the planners at the firm, and Matt will be taking you through a number of different items related to those changes. It shouldn't be a very long session today. Just a reminder that if you ever have topics or things that you are interested in seeing in a future webinar, please let us know. That's generally how we get topics for this, is from client questions and requests, and we like to make sure that we are diving into those things that are of most interest to you. So with that, we will have everybody else go on mute, and then we'll let Matt take this away. If you want to stay on afterwards for questions, feel free. Otherwise, we'll hope to catch up with you at another time or on the next webinar next month. Thanks. Go ahead, Matt.
All right, thank you. And thanks again for joining us on your Friday afternoon. As Quinn mentioned, the changes we're talking about today are from the year-end appropriations bill. Usually these are big bills that happen at the end of the year to cover various funding for government programs. But with the pandemic and because of some procrastination from Congress, a lot of other items got tacked into this year's or last year's appropriation bill. And in the end, this bill ended up being about 5,500 pages long, right at the end of December. And so a lot of different things to look through. Most of the pages you're not going to find applicable to, kind of your personal finances, but there are parts of this bill that are important and are getting a lot of press. So we just wanted to make sure you kind of understood some of these most important parts for you. The most notable part of the bill for maybe just the ordinary American is another round of stimulus payments. Similar to the first round in March, but a little slightly different execution. This round paid out $600 per person in the household, and that $600 began to get reduced if your income, or specifically your AGI or adjusted gross income, was above $150,000 if you're married, or $75,000 if you're single. And then every $100 in income that you have above that threshold starts to reduce that $600 payment by $5. And so the general idea behind this round of stimulus is about the same. Technically, how these amounts taper off is a little bit different. Larger families would be more likely to be eligible for this most recent round of payments than the first round, for example. So if you saw some difference in this most recent payment compared to the first one in March or April, that could be one reason for some difference. And also, depending on when you filed your 2019 taxes, your qualification for this round of stimulus could be different from the first one as well. This most recent stimulus was sent out based on your 2019 taxes, and the first round may have been based on your 2018 taxes if you had not filed your taxes by the end of March 2020 or so. And so if your income was higher in 2019 than it was in 2018, there could be some scenarios where you qualified for that first round of stimulus, or at least just received a partial payment, but then did not get anything or got a reduced amount this round. There is, if you were expecting a payment and haven't received one yet, on the IRS's website, they do have a tool to help you kind of track down your payment and let you know if you are eligible and if payment was on the way or not. So that's a good first place to check if you did really think, you should have got something and you haven't received it yet. And then if you did not receive a direct payment, though, you might still be eligible for the stimulus amount, but it will come in the form of a tax credit when you file your 2020 taxes before April here, and not necessarily a check. And this scenario would apply to those whose income was lower in 2020 than it was in 2018 or 2019. And so if this applies to you, there will be an extra worksheet to complete with your taxes this year. It'll be called a recovery rebate credit that gives you this stimulus payment, but just as a tax credit instead of a check. Tax preparers are going to be very familiar with this, and I'm sure services like TurboTax or Tax Act will automatically do a lot of the calculations needed as well. But if you know your income was lower than 150,000 or 75,000 and was higher in previous years where you didn't qualify, this would be a good item just to be familiar with and double check everything's right before you submit your taxes. Another important item for this bill is clarification on how the IRS will treat expenses incurred from the derecho for most of our clients, but also any other federally declared disasters during the year. You can thank our Iowa congressmen and congresswomen for getting this in the bill. They were big proponents of this extra few pages. And this bill extended a rule that was set to expire last year on how natural disaster losses are counted and treated come tax time. And we've talked with many of you about this already and probably showed you a worksheet that we put together that looks something like this image here. Just as a quick summary, you should get a special, what amounts to an addition to your standard deduction in 2020 for what's called your net loss or your loss in value. And most generally, this is just what you had to pay out of pocket to restore your property back to the condition it was in before the storm. And so if you were lucky and everything was covered by insurance, this might just be your insurance deductible then. But if you had a lot of damage that was not covered, tree damage, for example, was really common here, that you had to pay someone to help clean up that was not covered by insurance, you may be looking at receiving a larger deduction here. And the important item for you here is to make sure you have information organized come tax time so that you or your tax preparer knows exactly what you spent out of pocket. And so receipts are good to keep, any estimates that you got from contractors for their work. And the IRS recommends pictures as well, just to have documentation of some of that damage that was there. And lastly, of course, any paperwork from your insurance company is going to be good to keep on hand as well. There's one new added benefit for charitable gifts in 2021. If you remember, last year had a special $300 deduction for charitable cash donations that were given to qualified charities. And for 2021, that amount will stay at $300 for singles, but will now rise to $600 for married couples. And this deduction will be available to you even if you claim the standard deduction. And just shown here is an image for what your 2020 1040 form from the IRS will look like. And you can notice there's a new line here adding in the special deduction here for donations. And prior to the CARES Act last year, the big bill that was passed in March, if you claim the standard deduction, you received no additional deductions at all for smaller charitable donations like these $300 or $600. And so this made a great change and is a good way to incentivize people to make donations. And for you in 2021, what this means is that if you want to donate to charity this year, more than likely your first priority should just be cash contributions of up to $600 made to your favorite charity. And for those looking to make larger donations, this new bill passed at the end of the year also gives you a few more options. Actually, it extends options that were originally created under the CARES Act and extends those through 2021 now. And I'm not going to go over these options for larger donations in a lot of detail because we have 2 webinars already devoted to this topic. So if you're looking to make larger charitable donations this year, make sure to get in contact with us. We can at the very least send you that information, but we'd like to talk through it with you as well too, just so we can help you create a giving plan that's most beneficial for the charity and for yourself. Just as a quick summary, there have historically been limits to the amount of deductions that you can take for charitable contributions and just how much of your income you're able to offset. Those limits have been increased for last year and then now this year as well. And so if you really wanted to, you could offset every dollar in income this year with charitable giving from cash donations. Again, if you wanted to. Donor advised funds have slightly different limits. You can't quite offset everything, but you can still use these to offset a very large chunk of your taxable income during the year. And again, just talk to us if these larger donations is a strategy you were thinking about, because there's a lot of planning that can go around this scenario. And so those 3 changes we covered is maybe what we believe impacts the large majority of our clients, but there are a few other changes that could be very important depending on your situation. So we just wanted to run through some other bullet points here. First, there are a few changes around college planning and higher education that you might want to be aware of. First, popular tax deduction is going away. In the past, tuition and some other qualified education expenses gave you a tax deduction. That deduction is going away. However, they're making an already existing tax credit easier to qualify for, and that's the lifetime learning credit, which can give you up to a $2,000 tax credit. And previously it had a relatively low income threshold to qualify for this credit, but now the lifetime learning credit will be available to households with income up to $180,000 for married couples or $90,000 for single filers. For another change, the FAFSA, or the application for student financial aid, the process behind FAFSA is changing beginning in 2023. This law does not outline too many of the changes, so we don't know exactly what to expect in the future. We know the form will be shorter, which is good since it's pretty long currently, and how they calculate some of what's called the EFC, or expected family contribution, might be changing as well. And so maybe not urgent right now, but good to keep on your radar if you, a child, or a grandchild will be entering college in the next few years. And then lastly for this slide, not part of the bill that was passed at the end of the year, but part of an executive order just signed yesterday. Student loan payments will continue to be, or federal student loan payments will continue to be paused until the end of September now. So they were scheduled to begin shortly. This is going to extend it out another 8 or 9 months. And so if you are a family member has federal student loans, this is a great planning opportunity to help you build up savings or tackle other debt if you need to, and not have to worry about student loan payments. There's also a few other changes around medical expenses in the bill, a couple changes around FSAs, or flexible spending accounts. For last year and this year, unused funds can be rolled over, but it's based on your employer. So it's not mandated that they allow you to roll over unused funds, but the option is at least available now. There's not a lot of planning left for 2020. Unfortunately, since this got passed, in the last week of the year. But for 2021, now's a good time. You might want to reach out to your employer and find out if they're going to allow you to roll over any unused funds, just so you can plan on how to fund that account this year and whether or not you have to use all the money in it. And then for this year, contributions can be changed mid-year. And so you aren't locked in or nothing set in stone anymore, which should give you a little bit of flexibility once, once you find out how your employer is going to allow some extra money in it. You might want to fund it lighter or heavier depending on what your employer allows you to do. So just something to keep in mind. And a deduction during the year if you have very high medical expenses. This was going to require expenses up to 10% of your AGI, medical expenses above 10% of your AGI to qualify for any special deductions. And this year, and I believe going forward now, it's just going to be 7.5%. And so for those that have a lot of medical expenses or in years when you do, this could be a valuable deduction. And last notable change here, this could be a topic on its own. And so we decided not to get into a ton of detail on this, but we definitely want to bring it up and bring it to your attention that if you're a business owner or part of a small business, talk with us or for sure talk to an accountant to get an update on the changes in this bill. There are lots of changes and additions to PPP loans, for example, and a host of other business deductions and credits that are now available. And so we didn't want to spend a lot of time covering these in the webinar, but some of these could be really important for you. And so if you haven't looked at how these items have changed, be sure to check it out or talk with someone who is familiar with the changes. And one last bullet point we wanted to include here, something that didn't change in this bill that many people got used to in 2020 was RMDs. So RMDs are your required minimum distributions, will return in 2021 as of now. So this is for money in your 401k, IRA, or inherited IRAs. If you're of age that requires a RMD, expect to take that again this year. And again, doesn't apply to Roth IRAs or other brokerage accounts, but for some people with larger IRAs, this can be a big deal. And that's all. It's wasn't a ton of changes, but again, like Quinn mentioned, we wanted to make sure you were familiar with the changes. We're happy to answer any questions you have about this or anything else on your mind from this webinar. And if we don't talk to you again, have a great weekend and we'll see you soon.